Hey there, knowledge seekers. Ever wondered how companies truly know if they're hitting their goals or if they're just kind of guessing? Today, we're taking a deep dive, a real shortcut to being incredibly well informed on a critical business topic: variance analysis. At its heart, it's the art and science of comparing what was meticulously planned versus what actually unfolded in a business. It's how they separate the wishful thinking from the reality.
That's exactly right. Our mission today is to pull out the most important nuggets of knowledge from our detailed financial and accounting sources, helping you understand precisely where and why a company's actual performance might stray from its budgets. It's about finding those crucial aha moments in financial performance that lead to real, actionable insights and, frankly, better decision-making. No.
And we've got some fantastic in-depth sources to guide us through this, so let's peel back the layers and dive in. So, to kick us off, why do businesses put such an intense focus on these differences between what they planned and what actually happened? Isn't it enough to just know if you made money or lost money at the end of the month?
That's a really fundamental question, and the short answer is no, it's absolutely not enough. Just knowing your final profit or loss is, well, it's like getting a report card that just says pass or fail. It doesn't tell you anything about where you excelled or struggled. Variance analysis is a far more sophisticated investigation. It pushes beyond simple, high-level performance reports, which might just flag, hey, we spent more than we thought overall. Instead, it drills down into detailed per-unit examinations. Its core purpose is to truly dissect, understand, and explain every single deviation from the plan. Think of it this way. A basic performance report is like a quick temperature check. It tells you if you have a fever. But variance analysis, that's your full diagnostic scan, complete with detailed lab results. It doesn't just say you have a fever, it tells you why perhaps it's a bacterial infection or a specific system in your body is inflamed. It gives you that much deeper insight into performance, helping you pinpoint the exact areas for improvement, rather than just vaguely knowing there's an issue somewhere in the whole operation. It's the difference between knowing you're sick and knowing what medicine to take.
That diagnostic scan analogy really clicks. But I can imagine companies would need a perfectly dialed in normal reading to compare against. How do they establish that baseline? Is it even possible to have such precise standard costs in a dynamic business? That brings us directly to standard costing systems. What exactly are these standard costs that sound so official and precise?
You've hit on the core challenge of the brilliant solution. They absolutely need that solid baseline, and that's precisely what standard costing systems provide. They are, as you said, the bedrock for effective variance analysis. Standard costing systems are among the most common cost measurement systems used across various industries. At their heart, standard costs represent the costs a firm expects to incur, or perhaps more accurately, the costs it should incur, under efficient operating conditions during production. They act as a precise, predetermined benchmark against which all actual performance is measured. In essence, they're the ideal or target costs for a given level of output.
And what are those main manufacturing costs that get this standard treatment? What parts of the production process are we talking about here?
For almost any manufactured product, we're dealing with three main categories that get this meticulous standard cost treatment. First, raw materials. These are the direct inputs, the foundational ingredients of your product. Second, direct labor, which refers to the wages paid to the actual individuals directly involved in physically making the product. And then finally, we have manufacturing overhead. This category encompasses all the other indirect costs associated with the production process, things like factory rent, utilities, depreciation on machinery, or the salaries of supervisors who aren't directly making the product but are essential to production. For even deeper analysis, manufacturing overhead is often broken down into its variable and fixed components.
Wow, so they're defining the ideal cost for every single component. How are these standard costs actually calculated? What's the recipe, the formula for coming up with these precise expectations?
It boils down to a couple of straightforward calculations, but they're conceptually very important. For direct costs, think direct materials or direct labor. The standard cost is determined by multiplying the standard price by the standard quantity. Let's use a simple example. Imagine a company that manufactures artisanal wooden chairs. They wouldn't just guess. They would determine a precise standard price they expect to pay for each piece of wood, based on their purchasing agreements and market research. And they'd have a standard quantity of wood measured down to the precise board foot that they should use for each chair, accounting for minimal waste. You multiply those two, and you have your standard direct material cost per chair. Similarly, for direct labor, it's a standard hourly wage rate multiplied by the standard number of hours a skilled worker should take to make that chair.
Okay, that's for the direct stuff. What about the indirect costs, the overhead?
Right? For indirect costs, our manufacturing overhead, it's slightly different because they aren't directly tied to each unit produced in the same way. Here, the standard indirect cost is found by multiplying a standard or predetermined application rate by the standard quantity of a chosen cost driver. That application rate is essentially a rate per unit of activity that drives overhead, like dollars per direct labor hour or dollars per machine hour. So you budget your total overhead for a period, estimate your total expected labor hours for that period, divide the budgeted overhead by the estimated hours, and you get a rate. You then apply that rate based on the standard quantity of that cost driver, like labor hours, for the actual production achieved. It's an allocation method designed to tie indirect costs to units.
That's a lot of meticulous detail to get those standards set. So why do companies invest so much effort into setting these incredibly precise standards and then analyzing them? What's the real payoff for all this painstaking preparation?
The payoff is immense, and it serves three absolutely critical purposes. First, and often the most immediate benefit, is cost control. By having these clear benchmarks, managers can quickly pinpoint exactly where costs are exceeding expectations. It acts as an early warning system. Without standards, you might not realize you're consistently overspending on a certain material or labor process until it's far too late, or the problem has become entrenched, at a loss for swift corrective action.
Okay, so catching problems early, what else?
Second, it provides incredibly objective data for performance evaluations. When you have a clear, agreed-upon standard, you can objectively evaluate the efficiency and effectiveness of departments, specific production processes, or even individual teams. It moves beyond subjective assessments or gut feelings to hard, undeniable numbers. Did the purchasing department meet their price targets? Was the production team efficient with labor hours? The standards provide the answer.
Right, makes it much fairer.
Exactly. And finally, and this is where it gets really interesting, it provides the ability to learn from standards and continuously improve various processes. This isn't just about pointing fingers when things go wrong. It's about fostering a culture of continuous improvement. By analyzing why variances occurred, was it a bad supplier, outdated machinery, lack of training, or maybe even a flawed standard itself? Companies can learn from past performance, refine their production processes, improve purchasing strategies, or even adjust future budgets to be more realistic and effective. It's a feedback loop that drives organizational learning. It's huge.
So understanding this helps you grasp how companies don't just react to financial results, but proactively maintain financial discipline and continuously strive for operational excellence. It's how they stay competitive and profitable in the long run. It's about empowering smarter decisions. Beyond these specific operational benefits, what's the overarching fundamental goal when a company implements a standard costing system? What are they fundamentally trying to achieve with all the structure?
At its core, the primary objective is to attain a realistic, predetermined, or budgeted cost. This isn't just for historical tracking. It's absolutely crucial for future planning and accurate decision-making. By having these incredibly detailed expected costs, a firm can more accurately forecast its future profits, set competitive product prices, and even plan optimal production levels. And here's a significant side benefit, often overlooked. It greatly simplifies bookkeeping procedures. When you operate with standards, you can initially record costs at their standard values and then simply count for the differences or variances, which is far less cumbersome than painstakingly tracking every single actual cost in real time for every transaction.
We've used the word variance a lot. What exactly does it signify in this context? Let's define it clearly.
In its simplest form, a variance is just the difference between what actually happened and what was planned or budgeted. It's the gap between expectation and reality. When we're talking about costs, it's literally the difference between what you did spend versus what you should have spent. If your actual spend aligns perfectly with your standard, you have zero variance, a rare but ideal scenario.
So, when we see a variance, how do we know if it's good news or bad news? Is there a simple rule of thumb for evaluating the results quickly?
Absolutely. When evaluating the results of a cost variance, there are two primary classifications. A favorable variance occurs when an actual cost is lower than the standard cost. Think of it like a personal budget. If you budgeted $100 for groceries and only spent $90, that $10 difference is favorable. You saved money.
Got it. Lower cost is favorable.
Right. Conversely, an unfavorable variance occurs when an actual cost is higher than the standard cost. This means you spent more than you anticipated, and that's typically flagged as bad news because it eats into your profits.
That seems straightforward for costs. But are all variances created equal? Can management always do something about them? Or are some just out of their hands?
That's a crucial distinction, and it leads us to evaluating control. We differentiate between a controllable variance and an uncontrollable variance. A controllable variance is one that could have been prevented or influenced by management action. For example, if your production line workers were inefficient and took too long on a task, leading to higher labor costs, that's generally a controllable variance. Management could implement better training, provide clear instructions, or enhance supervision, things within their control.
Okay, makes sense. And uncontrollable.
An uncontrollable variance, on the other hand, is a variance that was not preventable by management action, often due to external factors completely outside their influence. For instance, a sudden, unforeseen spike in raw material prices due to global supply chain disruptions, geopolitical events, or a natural disaster would likely be an uncontrollable variance for the purchasing manager. This raises an important question when you analyze these variances about who is truly accountable and for what. You wouldn't want to unfairly blame a purchasing manager for an uncontrollable surge in global commodity prices, but you would want to hold them accountable if they failed to negotiate a good deal when market prices were stable and favorable. It's about fair assessment and targeted action.
That makes perfect sense. It's about assigning responsibility fairly and productively. So, where in the production process do companies typically look for these variances? What are the main categories of product costs that are analyzed most frequently?
Product costs generally consist of three major elements, and these are the primary areas subject to detailed variance analysis. First, direct materials, DM, which are the raw goods directly used in production. Second, direct labor, DL, the wages paid to workers directly involved in creating the product. And finally, manufacturing overhead, OH, which encompasses all other indirect costs associated with production. For even deeper insight, manufacturing overhead is usually further broken down into its variable manufacturing overhead, VOH, and fixed manufacturing overhead, FOH components. Each of these categories, both at a high level and in their subcomponents, can have multiple favorable or unfavorable variances that ultimately roll up into a comprehensive picture of financial performance.
Okay, so direct materials, direct labor, and manufacturing overhead. For both direct materials and direct labor, our sources highlight two very specific types of variances that companies really zero in on. What are these two core variances?
For both direct materials and direct labor, we typically dissect the overall cost difference into a pair of variances. A price variance, which for labor we call a rate variance, and a quantity variance, or for labor, an efficiency variance. The conceptual difference here is key, and it's very intuitive. The price or rate variance is all about what you paid per unit of material or per hour of labor, while the quantity or efficiency variance is all about how much material or labor you actually used relative to what you should have used for the output you achieved. It's about cost versus usage.
That makes sense. One is about the deal you got, and the other is about how efficiently you used it. Let's get into the specifics of how these are calculated. What are the exact formulas companies use to figure these out?
All right, let's break down each one slowly and clearly. Keep in mind, these are expense variances, so if your actual cost is lower than the standard, it's favorable, and if it's higher, it's unfavorable. For direct materials price variance, the formula is actual quantity purchased multiplied by actual price minus standard price. Imagine you plan to pay $10 for a unit of material, but you only paid $8. That $2 saving, multiplied by all the units you bought, is your favorable price variance. You got a good deal. Okay, so price difference times quantity bought. Exactly. Now, for direct materials quantity usage variance, it's standard price multiplied by actual quantity used minus standard quantity allowed. The standard quantity allowed is crucial here. It means how much material you should have used for the actual number of units you produced. So if you made 100 widgets and should have used 100 units of material, but you actually used 110, that extra 10 units, valued at your standard price, is your unfavorable usage variance. You're less efficient.
Right. Using more than you should have times the standard cost. Got it. Now for labor.
Shifting to labor. For direct labor rate variance, it's actual hours worked multiplied by actual rate minus standard rate. If your standard wage was $15 an hour, but you ended up paying $20, that $5 difference per hour multiplied by the actual hours worked is an unfavorable rate variance. You paid more per hour than expected.
Okay, similar to the material price variance.
Exactly, just with rates and hours. And for direct labor efficiency variance, standard rate multiplied by actual hours worked minus standard hours allowed. Again, standard hours allowed means the number of hours you should have used to produce the actual volume of output. If your workers completed the work in fewer actual hours than allowed, that efficiency saving, valued at the standard rate, gives you a favorable efficiency variance. They were faster than expected.
For those of us who are more visual learners or just trying to wrap our heads around these formulas, is there a more intuitive format that really shows the comparison without getting lost in the equations?
Yes, absolutely.
Yeah.
Many find the tabular format much more intuitive because it visually lays out the comparison of two totals side by side. You're essentially looking at different combinations of actual and standard prices and quantities to isolate the impact of each variable. For instance, to get the price variance, you compare the actual quantity at the actual price against the actual quantity at the standard price. The difference is solely due to the price. Then, for the quantity variance, you'd compare the actual quantity at the standard price against the standard quantity allowed at the standard price. The difference is solely due to the quantity used. It kind of steps you through it.
And the favorable, unfavorable rule.
The general rule for determining favorable or unfavorable in this tabular format is straightforward. If the actual figure, usually on the left side of your comparison, is larger than the standard figure on the right, then the variance is unfavorable. If the actual is smaller, it's favorable. It creates a very clear visual flow for the calculation and helps you see the drivers of the variance.
Let's bring these concepts to life with the specific examples provided in our sources. This really helps make the numbers meaningful. Let's start with direct materials variances.
All right, for direct materials, here are the facts from our source. Actual quantity purchased, 200 units. Actual quantity used, 110 units. Unit standard quantity, 100 units. Remember, this is the standard quantity allowed for the actual production you achieved. Actual price paid, $8 per unit. And the standard price, $10 per unit.
Okay, 200 bought at $8, $110 used, should have used 100, standard price $10. Got it.
Now, let's calculate the direct materials price variance first, using the formula. Actual quantity purchased multiplied by actual price minus standard price. That's 200 units multiplied by $8 per unit minus $10 per unit, which gives us 200 units times -2 equals $400, favorable.
Favorable because they paid less than standard.
Exactly. The company paid $2 less per unit than the standard price, resulting in a saving of $400. This is typically a feather in the cap for the purchasing department. They got a good deal.
Nice. Okay, what about the quantity variance?
Next, the direct materials quantity variance. Standard price multiplied by actual quantity used minus standard quantity allowed. That's $10 per unit multiplied by 110 units used minus 100 units allowed, which gives us $10 times 10 units equals $100. Unfavorable.
Unfavorable. Why?
Because the company used 10 more units of material than the standard allowed for the actual production achieved. This indicates some waste or inefficiency on the factory floor, perhaps due to scrap, rework, or just less efficient handling of materials.
So what does this all mean? They got a great deal on the materials themselves, which is excellent, but then they use too much of it in production, which is not so great. That's a fascinating and slightly frustrating trade-off.
Precisely. This is where the analysis gets really insightful, moving beyond just simple numbers. This scenario tells a compelling story. It could imply a few things. Perhaps the purchasing department, in securing that $2 saving per unit, acquired materials of slightly lower quality that were harder to work with, leading to increased waste in production.
That's a possibility. Cheaper isn't always better if it causes waste.
Exactly. Or perhaps the purchasing team did an excellent job, full stop. But the production department needs to seriously review its processes and improve efficiency, regardless of material quality. This example perfectly illustrates how different variances can interact and tell you a more complete, nuanced story about performance, rather than just looking at a single overall cost. It empowers management to ask, was that cost saving worth the extra waste?
Okay, let's move on to direct labor. What do our sources show for an example there?
For direct labor, here are the facts.
Yeah.
Actual hours worked, 450 hours, standard hours. 500 hours, again, this is the standard hours allowed for the actual production completed. Actual paid rate, $20 per hour. And the standard rate, $15 per hour.
Okay, 450 hours worked at 20 hours. Should have taken 500 hours at $15. Let's see.
Let's calculate the direct labor rate variance. Actual hours worked multiplied by actual rate minus standard rate. That's 450 hours worked multiplied by $20 per hour minus $15 per hour, which comes to 450 hours times $5 works $2,250. Unfavorable.
Unfavorable, that makes sense. They pay $5 more per hour. Ouch.
Right. This could be due to unexpected overtime, a higher skilled workforce than budgeted, or perhaps a union negotiation that led to higher wages. Now, for the direct labor efficiency variance, Standard rate multiplied by actual hours worked minus standard hours allowed. That's $15 per hour multiplied by 450 hours worked minus 500 hours allowed, which results in $15 times negative 50 hours equals $750 favorable.
Favorable. So they worked fewer hours than planned.
Yes, because the workers completed the task in 50 fewer hours than the standard allowed for the actual production volume. This indicates high efficiency. They were faster or more productive than expected.
Here's where it gets really interesting. They paid their workers more per hour, which is unfavorable, but those workers were actually faster than expected, which is favorable. That's a surprising combination and almost counterintuitive for some businesses.
It absolutely is, and this is exactly where the real value of variance analysis shines. What could explain this intriguing dynamic? Perhaps the company made a strategic decision to hire highly skilled and thus higher paid workers who were able to complete the task much quicker than the standard hours allocated for that volume of production. The higher hourly rate was offset by significantly fewer hours worked overall.
Or maybe overtime.
Or it could be that they had to pay overtime rates to meet a tight deadline, which increased the cost per hour, but the motivation of overtime or the critical need for speed meant the work was done much faster. This demonstrates how different variances can tell a complex story about operational choices and their direct financial impact. It's never just one number, it's the interplay between them. It forces managers to ask, was paying more for labor a bad thing, or did it deliver valuable efficiency or meet critical deadlines?
Okay, that really clarifies the direct cost variances. Let's move into the potentially trickier area, manufacturing overhead. Manufacturing overhead can sometimes feel like a financial black box for many, simply because it includes all those indirect costs that aren't clearly materials or direct labor. How do we even begin to analyze these costs effectively?
You're right, it can feel a bit more elusive than direct costs because you can't simply count the units of glue or the hours of a supervisor for each widget. But at a high level, the analysis of manufacturing overhead compares the actual overhead incurred in a period to the applied overhead for that same period. Remember, overhead isn't directly traceable to each unit, so it's estimated and then applied or allocated to products based on a predetermined application rate, typically using a suitable cost driver, like direct labor hours or machine hours. This applied overhead is the amount expected to be assigned to the actual units produced based on those standard rates.
And what do these terms underapplied and overapplied actually mean for a company's bottom line? They sound like they have significant implications.
They are very important because they directly impact the company's profitability. Underapplied overhead occurs when the actual overhead incurred exceeds the amount of overhead that was applied to products. This results in an unfavorable variance because, simply put, the company spent more on overhead than it expected and assigned to its products. It leaves a net debit balance in the overhead account, signifying that more cash went out than was accounted for in the cost of goods produced.
So underapplied, spent more, unfavorable.
Exactly. Conversely, overapplied overhead occurs when the actual overhead incurred is less than the amount applied to production. This is a favorable variance because the company spent less than anticipated, resulting in a net credit balance. Imagine a personal budget. If you budget a certain amount for your monthly utility bill, that's your applied overhead. If your actual bill comes in higher than your budget, you've underapplied your budget, and you have an unfavorable variance because you have to pay more. If your actual bill is lower than your budget, you've overapplied your budget, which is favorable because you saved money. It directly impacts your cash flow and ultimately your profitability, often adjusting the cost of goods sold.
Our sources delve deeper, breaking down overall manufacturing overhead variance into 4 specific components. This seems like a critical distinction for truly understanding overhead. What are these 4 pillars?
You're absolutely right. For a complete picture, the total manufacturing overhead variance is typically broken down into 4 distinct components. These allow management to pinpoint exactly why overhead went off plan. They are 1. Variable overhead VOH rate spending variance. This looks at the cost per unit of the variable overhead driver itself, like the price of utilities per machine hour. Did we pay more or less for our variable overhead resources? 2. Variable overhead VOH efficiency variance. This measures how efficiently the underlying cost driver, like direct labor hours or machine hours, was utilized relative to the actual production achieved. Did we use more or fewer hours than we should have to make the product?
Okay, rate and efficiency for the variable part. What about fixed?
3. Fixed overhead. FOH, budget spending variance.
Right.
This is straightforward comparison of the total actual fixed costs incurred versus the total budgeted fixed costs. Did we spend more or less on our fixed items like rent or insurance? And 4. Fixed overhead, FOH, volume variance. This relates to how effectively the company utilized its production capacity given its fixed costs. Did we produce as many units as our factory was set up to handle, spreading those fixed costs effectively?
Before we calculate these four variances, how do companies even establish the rates used to apply overhead? And how is that application carried out? It sounds like there's a very specific methodology.
There absolutely is a specific methodology, and it's foundational to understanding these variances. First, establishing the rates. Predetermined fixed and variable overhead rates are set by taking the total planned fixed and variable overhead amounts and dividing them by a suitable cost driver. That cost driver needs to be something that truly correlates with and drives the overhead cost, like total estimated direct labor hours, total estimated machine hours, or even total units produced. The choice of the right driver is crucial for accurate assignment of overhead.
Okay, so you figure out a rate per hour or per unit or something.
Exactly. Then, for the application of overhead, it's a two-step process, which is often remembered by accounting students as a pass key, a mental shortcut. Step 1. Calculate the predetermined overhead rate. This is simply your budgeted overhead costs divided by the estimated total cost driver. This gives you a rate, say, dollars per direct labor hour. This rate is usually calculated at the beginning of the period. Step 2. Apply overhead. Once you have that rate, you multiply it by the standard quantity of the cost driver allowed for the actual level of activity achieved. This means overhead is applied not based on the actual hours worked, but based on how much activity should have occurred to produce the actual units. This is a key point because it ties the applied overhead directly to the efficiency of production.
Once these variances are calculated, how do we interpret them? What do favorable and unfavorable overhead variances ultimately mean for a company's financial health and profitability?
The interpretation is consistent with what we discussed earlier for direct costs, but with a slight twist, because overhead often ends up as part of cost of goods sold. Generally, for overhead, overapplied overhead, which results in a net credit balance in the overhead account, is favorable. Why? Because it ultimately results in a credit to cost of goods sold, TOGS, at the end of the period, typically reducing that expense. And reducing COGS means reducing your overall expenses, which directly increases your profits.
So overapplied is good, increases profit.
Right. And underapplied overhead, meaning a net debit balance, is unfavorable. Why? Because it eventually leads to a debit to COGS, which increases your expenses and therefore decreases your profits.
Underapplied bad, decreases profit. Got it.
It's important to emphasize that the sum of all individual overhead variances, the VOH rate, VOH efficiency, FOH budget, and FOH volume variances, will always precisely equal the net balance in the overall overhead account. So if you've got an underapplied total, these four variances will break down why that happened, giving you a holistic view of where your indirect costs went off track and impacted the bottom line.
Let's break down each of these four overhead variances in more detail, starting with the two variable components. What about the VOH rate spending variance? What does that tell us?
The VOH rate spending variance uses the formula, actual hours multiplied by actual rate minus standard rate. This variance is crucial because it tells managers whether they spent more or less than expected on variable overhead per unit of the cost driver. For instance, if your cost driver is direct labor hours, this variance would capture if the actual cost of utilities, like electricity per machine hour, or indirect supplies, like lubricants for machines per labor hour, was higher or lower than anticipated. A favorable variance means the standard rate exceeded the actual rate you paid less for these variable overhead items per unit of activity. An unfavorable variance means the actual rate exceeded the standard rate you paid more. It's about the price you paid for your variable overhead resources.
And the other variable component, the VOH efficiency variance, how does that differ from the rate variance?
The VOH efficiency variance formula is standard rate multiplied by actual hours minus standard hours allowed for actual production volume. This variance is incredibly important because it's directly tied to how efficiently the underlying cost driver, like labor hours or machine hours, was utilized to achieve the actual output. It isolates the portion of the total variable overhead variance that is due to using more or fewer direct labor hours than what was budgeted for the actual number of units you produced. So given what you successfully manufactured, did it take more or fewer labor hours than it should have? A favorable variance results from using fewer labor hours than budgeted, signifying efficiency. An unfavorable variance stems from using more. What's fascinating here is that you can have a great VOH rate, maybe your utility costs were cheaper than expected, but if you're terribly inefficient with the underlying activity, say your machines ran excessive hours for the widgets they produced, your overall variable overhead can still be unfavorable due to that inefficiency. It links the efficiency of your direct labor or machine usage to your indirect costs.
Now let's shift to the fixed overhead variances. Tell us about the FOH budget spending variance.
The FRH budget spending variance is perhaps the most straightforward of the overhead variances. Actual fixed overhead minus budgeted fixed overhead. Companies budget a specific total amount for their fixed overhead costs every period. Think things like factory rent, building insurance, property taxes, or the fixed salaries of factory supervisors. This variance simply asks, did you spend more or less than your total budget for these fixed costs? A favorable variance occurs when your actual fixed overhead costs are less than budgeted, which means you save money directly on these big-ticket fixed items. An unfavorable variance results from actual costs exceeding the budgeted amount. It's a direct apples-to-apples comparison of total spending on fixed costs, usually indicating effective cost control or lack thereof by the responsible manager.
And the final one, which sometimes can be tricky for people to grasp, the FOH volume variance. How does that work and why is it important?
The FOH volume variance formula is budgeted fixed overhead minus standard fixed overhead cost allocated to production. And that standard fixed overhead cost allocated to production is based on the actual production multiplied by the standard fixed overhead rate. This variance is crucial because it arises entirely due to differences between your expected production volume and your actual production volume, given that fixed overhead costs are applied to products using a rate based on that expected volume.
So it's about how much you actually produced versus what you expected to produce.
Precisely. Think about it this way. Your factory rent is a fixed cost. You pay the same amount whether you produce 100 widgets or 10,000 widgets. If you plan to produce 10,000 units and base your per-unit fixed overhead rate on that, but you only managed to produce 8,000 units, you've underutilized your fixed capacity. That means those fixed costs are spread over fewer units than anticipated, making each unit disproportionately expensive from a fixed cost perspective. So a favorable variance occurs when your actual volume is higher than anticipated, meaning more units were produced using the same amount of fixed resources. An unfavorable variance occurs when actual volume is lower than anticipated, meaning fewer units were produced using a fixed amount of resources. If we connect this to the bigger picture, this variance isn't about controlling the amount of fixed costs, because those are largely set, but about how effectively the company utilized its production capacity during the period. It's a measure of how efficiently you're leveraging your fixed assets, like your factory building and machinery.
Let's take a comprehensive example from our sources to see how all four of these overhead variances are calculated and what they tell us about a company's performance. This is Lucy Inc. and their widget production. This should really tie it all together.
Excellent. This example from Lucy Inc. is perfect for illustrating the interplay of these four variances. Here are the facts. Budgeted info. They plan to make 4,000 widgets. Standard is 1 labor hour per widget, so 4,000 total budgeted hours. Standard VOH rate is $1.50 per hour. Standard FOH rate is $3 per hour. And budgeted FOH costs are $12,000 total. Actual info for January, they actually made 3,900 widgets. They used 3,900 actual labor hours. Actual VOH rate was $1.60 per hour. Actual VOH costs came to $6,240, and actual FOH costs were $10,560.
Okay, budget versus actual. Let's break down the variances. VOH rate first.
Right. First, the variable overhead, VOH rate, spending variance, formula. Actual hours times actual rate, standard rate, calculation. 3,900 actual hours times on all $1.60, $1.50, or reports as 3,900 times $0.10, bills $390. Unfavorable. Interpretation. The actual variable overhead rate was higher than anticipated by 10 cents per hour. Maybe electricity costs more, maybe indirect supplies, something like that.
Okay, unfavorable rate. Now VOH efficiency.
Second, the variable overhead VOH efficiency variance. First, we need the standard labor hours allowed for the actual production. 3,800 actual widgets produced times $1.00 standard hour per widget equals 3,800 standard hours. Formula. Standard rate times actual hours, standard hours allowed. Calculation. $1.50 standard VOH times 3,900 actual hours, 3,800 standard hours allowed. $1.50 times 100 hours, $150. Unfavorable. Interpretation. It took 100 more labor hours than anticipated for the actual production volume of 3,800 widgets. Inefficiency in labor usage hurt variable overhead too.
Another unfavorable. Okay, what about the fixed overhead variances? FOH budget.
Third, the fixed overhead, FOH, budget spending variance, formula, actual fixed overhead, budgeted fixed overhead, calculation, $10,560, actual FOH, $12,000, budgeted FOH, $1,440 favorable.
Ah, finally some good news. They spent less on fixed costs.
Exactly. This is fantastic news for Lucy Inc. The company spent $1,440 less on total fixed overhead than originally budgeted. Maybe lower rent, delayed spending, Good cost control here.
Nice save. What about the last one, FOH volume variance?
Finally, the fixed overhead FOH volume variance. First, we need the standard fixed overhead cost allocated to actual production. That's the 3,800 standard labor hours for actual production multiplied by the standard FOH rate of $3 per hour, which equals $11,400. Formula. Budgeted fixed overhead, standard fixed overhead cost allocated calculation. $12,000 budgeted FOH, $11,400 standard FOH allocated. $600. Unfavorable. Interpretation. The company produced fewer units, 3,800 actual versus 4,000 budgeted, than anticipated. This means their fixed capacity of their factory was underutilized. Those fixed costs got spread over fewer units.
Okay, so unfavorable volume. Let's add them all up.
Right. If we sum all these variances to get the overall overhead variance, $390 unfavorable plus $150 unfavorable plus $1,440 favorable plus $600 unfavorable expressed numerically, minus $390 plus $150 plus $1,600 $600 favorable. And we can quickly confirm this by comparing the total actual overhead incurred. $10,560 FOH plus 60 hours for 240 VOH equals $16,800 to the total overhead applied to production. $11,400 FOH plus $5,700 VOH is $17,100. So $16,800 actual minus $17,100 applied equals a $300 favorable overall variance, perfectly matching our sum. It checks out.
So what does this all mean for Lucy Inc.? Despite some clearly unfavorable spots, they actually managed to end up with an overall favorable overhead situation. How do they achieve that, and what's the big takeaway for management?
This is a great illustration of how the variances tell a comprehensive and often surprising story. Lucy Inc. did experience some inefficiencies in their variable overhead. They paid a higher rate for VOH, and they were less efficient in using labor hours, both unfavorable. They also produced fewer widgets than budgeted, leading to an unfavorable fixed overhead volume variance because their factory capacity wasn't fully utilized.
How a big save.
The big save. The significant savings on their actual fixed overhead spending, that $4,440 favorable variance, was large enough to completely offset those other unfavorable variable overhead and volume variances. The big takeaway for management is that performance isn't a single number, it's a dynamic interplay. While the production floor might need to tighten up its variable overhead efficiency and volume utilization, the finance or administrative teams did an excellent job managing the company's fixed expenses. This kind of detailed analysis empowers managers to understand where to focus their attention. It's not just about overall cost, but about dissecting the specific drivers of profitability and identifying both strengths and weaknesses within different operational areas. It's the kind of insight that helps them allocate resources and implement targeted improvements.
Okay, we've covered costs inside and out. Let's shift gears. So far, we've focused heavily on the cost side of the equation. We've seen how companies dissect every penny spent. But what about the revenue side? How do companies analyze their sales performance against what they expected? After all, it's not just about what you spend, it's about what you bring in, and ideally, more.
Absolutely. Sales variance analysis is just as crucial, if not more so, for evaluating the effectiveness of an entity's strategies for identifying target markets, winning customers, and capturing those markets. It's all about understanding precisely why actual sales revenue differs from budgeted sales revenue. Just like with costs, you meticulously set a budget for sales revenue, and then you want to know why you hit it, or why you missed it, or perhaps why you exceeded it in unexpected ways. It provides feedback on your marketing and sales efforts.
Just like with costs, our sources indicate there are two primary components of the overall sales variance. What are they?
That's right. The total sales variance, the difference between actual sales revenue and budgeted sales revenue, has two main components that help us dissect the story: the sales price variance and the sales volume variance. Each tells a distinct part of the revenue story.
Let's start with the sales price variance. How is that calculated, and what does it tell a company?
The sales price variance is calculated as actual quantity sold multiplied by actual price minus standard price. This variance measures the aggregate effect when the actual selling price you achieve differs from the budgeted selling price. A favorable variance occurs when the actual selling price is higher than budget, which is great news. You got more revenue per unit than anticipated. An unfavorable variance occurs when it's less than budgeted, meaning you had to sell your product for less. This is often due to discounting, competitive pressure, or maybe a change in product mix towards lower-priced items.
Okay, let's see an example. Cascade Company.
Yes, let's look at the example from our sources for the Cascade Company. Facts for Cascade Company. Budgeted units sold, 3,000 units. Budgeted sale price, $16 per unit, actually sells. 4,000 units, actual price, $14 per unit.
So they planned 3,000 units at $16, but sold 4,000 at $14.
Exactly. So using the sales price variance formula, 4,000 units actual quantity sold times $14 actual price, $16 standard price. This calculates to 4,000 units times -2 equals $8,000 unfavorable.
Unfavorable because they sold for $2 less per unit.
Precisely. Cascade Company sold its product for $2 less per unit than it anticipated, leading to reduced revenue from each individual sale. This suggests they either had to lower prices to move product, face stronger price competition, or perhaps sold to a different customer segment that commanded lower prices.
Okay, now for the sales volume variance. How is that one derived and what does it reveal?
The sales volume variance is a crucial flexible budget variance that quantifies how much of the total sales variance is traceable purely to differences in the number of units sold. It uses the formula, standard price multiplied by actual quantity minus standard quantity. A favorable variance exists when more units are sold than budgeted. That's generally excellent news, indicating strong demand or effective sales efforts. Conversely, an unfavorable variance occurs when fewer units are sold than budgeted, suggesting weaker demand or issues with sales execution. Notice it uses the standard price here to isolate the effect of volume only, removing any price fluctuations.
Okay, standard price times the difference in quantity sold. Let's use Cascade again.
Using the same facts for Cascade Company, budgeted 3,000 units at $16 standard price, actually sold 4,000 units, so using the formula, $16 standard price times 4,000 units actual quantity, 3,000 units, standard quantity. This calculates to $16 times 1,000 units equals $16,000 favorable.
16,000 favorable. Why?
Because Cascade Company sold a phenomenal 1,000 more units than it anticipated. This is excellent for overall revenue and clearly indicates strong market acceptance or very effective sales and marketing campaigns.
So what does this all mean for Cascade? They sold their product at a lower price per unit, which was unfavorable, $8,000 used, but they sold a lot more units than expected, which was overwhelmingly favorable, $16,000 F. That's a dynamic and somewhat paradoxical situation for many businesses.
It truly is dynamic, and it perfectly highlights a common strategic dilemma. The lower actual selling price, that $8,000 unfavorable price variance, might have been a deliberate strategy on Cascade's part to stimulate demand, penetrate a new market, or gain market share. This strategic price reduction could then have directly led to the significantly higher volume, resulting in that $16,000 favorable volume variance. Management at Cascade needs to assess if this trade-off, a lower margin per unit, but significantly higher overall volume, aligns with their broader strategic objectives and long-term profitability goals. In this specific case, the overall effect is positive. $16,000 F, $8,000 U equals also $8,000 favorable overall. But it requires careful strategic analysis to understand why those variances occurred and if the price reduction was an intentional and successful part of their strategy, or if it was an unplanned reaction to market pressures. It's about profitable growth versus growth at any cost.
That's a great point about strategy and intentional trade-offs. But what happens when a company sells not just one product, but many, especially if those products have vastly different profitability levels? This sounds like it could get very complicated trying to figure out why total sales might be off, even if total units hit the target.
It absolutely can, and that's precisely why we introduced the sales mix variance. This variance is designed for organizations that sell a portfolio of products where anticipated sales revenue is derived from the sale of multiple items, and crucially, these products often have varying contribution margins. Some products are inherently more profitable per unit than others. The key insight here is profound. Even if your total sales volume for all products combined meets projections, if the ratio or mix of products you actually sold differs from your anticipated sales mix, then your net income may still deviate significantly from the budget. You could sell the exact number of units you planned overall, but if you sold more of your less profitable items and fewer of your highly profitable ones, your bottom line will suffer, and this variance explains why.
So what's the formula and the core concept behind this sales mix variance? It sounds like it gets into some serious strategic territory.
It does. The formula for sales mix variance for a specific product within your portfolio is actual sales mix ratio for that product minus budgeted sales mix ratio for that product, multiplied by a discernant. Total number of units of all products sold multiplied by budgeted contribution margin per unit of that product. It looks a bit complex, but the idea is simple.
Okay, break down that concept a bit more.
The core concept here is that this variance tells you if a shift in the sales composition, for instance, selling a higher proportion of a lower margin product and a lower proportion of a higher margin one, negatively impacted your profitability, even if your overall quantity sold was exactly as planned. It isolates the impact of just the change in the proportion of each product sold, holding total volume and prices constant. It reveals if your sales team is pushing the right products for maximum profitability.
Our sources provide a perfect example of this with Neostar Corporation and their Nova and Sunbeam products. This is fascinating because the total combined sales volume was exactly as expected, yet the company's net income didn't meet expectations. How can that possibly be if they hit their overall volume target?
This is a classic real-world scenario that the sales mix variance is specifically designed to explain, and it often surprises people. Neostar sells two distinct products, Nova and Sunbeam. The crucial insight to highlight from our source material is the significant difference in their budgeted contribution margins per unit. Nova has a higher budgeted contribution margin of $5 per unit, while Sunbeam has a lower one at $4.17 per unit. This profitability difference is absolutely critical for understanding the variance.
Okay, $5 profit for Nova, $4.17 for Sunbeam. Got it. What was their plan versus reality?
Let's look at their master budget versus actual results for the period. Master budget, expected sales mix and volume. Nova, budgeted to sell 4,000 units, which represents 40% of the total budgeted sales mix, 4,000, 10,000 total. Sunbeam, budgeted to sell 6,000 units, representing 60% of the total mix, 6,000, 10,000. Total budgeted units, 10,000 units. Actual results, actual sales mix and volume. Nova actually sold only 1,000 units, representing just 10% of the total actual sales mix, 10,000. Sunbeam actually sold 9,000 units, representing a substantial 90% of the actual mix, 9,000, 10,000. Total actual units, 10,000 units.
Okay, so total units, 10,000 budgeted, 10,000 actual, bang on. But the mix, wow.
Exactly. Crucially, you'll notice that the total units sold 10,000 was exactly the same as budgeted. They hit their aggregate volume target dead on. However, the mix shifted dramatically. They sold much less of Nova, their higher margin product, and much more of Sunbeam, their lower margin product.
So the total volume was on target, but the individual proportions of high profit versus low profit items changed. Let's see the computation of the sales mix ratio to make that even clearer. How much did each product's proportion shift?
Absolutely. For Nova, the budgeted mix was 40%, but the actual mix was only 10%. That's a negative shift of negative 30%, 10 to 40%. For Sunbeam, the budgeted mix was 60%, but the actual mix jumped to 90%, a positive shift of plus 30%, 90%, 60%. These percentage differences are what we'll use to quantify the impact of the mix change.
Okay, negative 30% for the profitable one, plus 30% for the less profitable one. Now the calculation.
Now let's walk through the detailed sales mix variance calculation for each product, as outlined at our source. For Nova sales mix variance, we take the difference in sales mix ratio, 10%, actual mix, 40%, budgeted mix, Ignis 30%. Multiply that by the total units sold, 10,000 units. Multiply again by Nova's budgeted contribution margin, $5, calculation. Negative 30% times 10,000 units times $5, $15,000. Unfavorable.
15,000 unfavorable from Nova because they sold less of it.
Exactly. This is unfavorable because they sold a significantly lower proportion of Nova, their more profitable product, than planned. They missed out on $15,000 of potential contribution margin from Nova because of this mix shift. Now for Sunbeam sales mix variance, difference in sales mix ratio, 90% actual mix, 60% budgeted mix, plus 30%. Multiply by total units sold, 10,000 units. Multiply again by Sunbeam's budgeted contribution margin, $4.17 calculation, plus 30% times 10,000 units times $4.17 is $4.17. Favorable.
Favorable for Sunbeam because they sold more.
Right. This is favorable because they sold a much higher proportion of Sunbeam, their less profitable product, than planned. They gained $12,500 of contribution margin from Sunbeam due to this mix shift. But notice, even though the percentage shift was the same, plus 30%, the dollar impact is less because Sunbeam's margin is lower.
So the total variance...
If we sum the individual variances, minus $15,000 from Nova plus $12,500 from Sunbeam, $2,500. Total unfavorable sales mix variance.
Wow. What stands out to you? Neostar sold the exact number of units they expected, yet their operating income was lower than budgeted, and we've just pinpointed why. A $2,500 unfavorable sales mix variance. That's a powerful revelation.
What stands out is how deceptive overall volume numbers can be. This example reveals a powerful truth. Total sales volume can be a lie. The core reason for this $2,500 unfavorable variance is precisely what we discussed. The company sold less of the higher contribution margin product, Nova, at $5 per unit, and more of the lower contribution margin product, Sunbeam, at $4.17 per unit. Even though the total volume target was hit, the profitability of the sales mix was lower than anticipated, directly impacting their net income.
That's huge.
It is. If we connect this to the bigger picture, this demonstrates that simply achieving sales volume targets isn't enough. Companies must also actively manage their sales mix to maximize profitability, especially when dealing with a diversified product portfolio. This analysis encourages critical thinking beyond just top-line revenue numbers and really forces management to understand not just how much they sold, but what they sold and at what profitability. It's an essential tool for strategic decision-making in a multi-product environment, making sure your sales efforts are not just generating revenue, but profitable revenue.
Wow, what an incredible journey into the heart of business performance. We've truly had a deep dive today. From the foundational concepts of standard costing and those immediate crucial variances for materials and labor, through the sometimes complex but ultimately revealing world of manufacturing overhead, and finally into the strategic realm of sales and sales mix variances. You've now got the tools to understand how businesses measure, dissect, and fundamentally improve their performance with incredible precision.
And that's the true power of variance analysis. It's not just about crunching numbers or, as we've seen, merely identifying that a problem exists. It's about the rich, detailed story those numbers tell. It provides critical insights for granular cost control, allows for objective and fair performance evaluation, and, most importantly, fuels continuous improvement. By truly understanding these deviations from the plan, businesses can adapt, optimize their operations, pinpoint strategic shifts, and ultimately thrive in competitive markets. It's how companies move from reactive to proactive.
So, next time you hear a company celebrating hitting their sales targets or keeping costs down, you'll have the insights to ask. But what about the variances? What does the mix tell us about their true profitability? Which of these variances do you think are most important for a high-growth tech startup to track, compared to a mature manufacturing company focused on efficiency? A tech startup might obsess over sales volume and efficiency variances because they're scaling rapidly, whereas a mature manufacturer might drill down into materials, price, and fixed overhead volume variances to optimize every last penny. That's your provocative thought for the day, to continue this deep dive on your own. Thank you for joining us on the deep dive and continuing to explore the world of informed decision making. We'll catch you on the next deep dive.